morning. I hope you enjoyed Maureen's presentation. I think she provided a wealth of information about strategies and tips on how to best leverage technology, to help your organizations really take your fundraising efforts into the future, and provide some permanent change in response to what we've encountered over the last 14 months. What I'm going to share with you today really is a focus and a discussion, if you will, on looking beyond the tried and true contributions and other forms of public support, and really focusing more on a longer term strategy, looking at revenue diversification and whether or not it's appropriate for your organization as part of that long-term financial planning to consider adding an earned revenue or for-profit business activity to part of your long-term financial plan. As we're all familiar with the saying, no money, no mission. And I know in the last 14 months, I've received numerous phone calls from organization leaders who are experiencing some short-term financial difficulties because of the pandemic, asking for advice on what can we do? And normally the questions are all focused on the short term. I'm trying to respond. We all heard Maureen talking about the very nature, if you will, or a characteristic of the nonprofit organizations in the nonprofit industry, that we tend to be reactive. What I'm going to engage you in is a discussion about, can we dream together and really look at something that is more longer term focused? Maybe it's going to seem a little bit out of the box, but it's very, very important that combination between what can we do with respect to our ongoing work around fundraising, how does that's going to get us part of the way there. But there are multiple things we need to consider. Not only is it the tried and true contributions and the reliance upon our donors, but many of you also are receiving contracts and financial support from foundations, governmental funders, other regulatory related agencies. All of these things, are subject to a great deal of volatility. One year to the next, who knows what donor preferences are going to be. One administration to the next, who knows what the regulatory and governmental funding sources are going to be. What I'm talking about now is, can we add that third earned income component to our financial strategy that helps us build for the future, and a platform where we can achieve financial stability and long-term resiliency, for our organizations. So with that, the topic of the day, revenue diversification, and how could we possibly use a for-profit subsidiary or a commercial for-profit business activity to help create that long-term financial stability. First and foremost, if you're going to venture down this pathway, we have to get together as leaders in the organization, and there has to be a well thought out, solid business case for taking on the risk, the additional managerial responsibility, and everything associated with operating a business or an activity that really may or may not align with our core mission purpose. Why do we want to do this? What are the reasons? Well, we've obviously stated the most important one, or at least the one that's most commonly identified, and that's the need for new sources of revenue. We need money. Again, money, no mission. Risk management. Unrelated business activities, have been around, as a component of an organization's financial strategy for years. This is not a new concept. Many organizations have built in, social functions, social enterprises, commercial activities in their ongoing operations. The model has always been there that we can engage to a certain degree, and I'll discuss that in a moment here, in commercial activities to generate revenue to support our mission. But historically, those activities have always resided, if you will, inside the organization. What I'm going to talk about is a strategy to move those into a separate entity. And one of the benefits of that is it provides risk management. It shelters the nonprofit organization and the nonprofit organization's financial assets and resources from the risk of litigation or exposure to certain regulatory issues and things, because the activity resides in a separate legal structure. Another good part of the business case, if we move this into a commercial entity, for example, is we now have the ability to engage outside investors. We can start a company, we could own 51%, we could finance that operation with 49% of investment from individuals or other businesses. Another reason to possibly move this into a separate entity is it gives us a greater ability to attract and retain and compensate employees that have the requisite skills, knowledge, and experience to operate the commercial activity. One shortfall that I've seen in a number of social enterprises conducted inside of a nonprofit organization is this ongoing struggle with how do we attract the necessary talent and fit it into compensation models that are consistent and comparable to how we compensate our folks that are working inside the organization, carrying out programmatic activities. Another benefit of possibly putting this operation in a separate commercial entity is down the road, if the value of this business increases, we now have an asset that we can sell. So this is not necessarily a permanent commitment. We could put some activities in a commercial business with the strategy that we want to grow and increase value, and then down the road we want to liquidate our investment, harvest the cash, and use that for additional expansion of programs and furtherance of our mission. Another reason to separate it and put it in a separate entity might be branding and how the market perceives us. Disadvantages. Well, the disadvantages of doing this is the initial investment and startup costs could be prohibitive. I'm going to challenge you, if we don't have the capital to do this now, maybe our financial strategy is coming up with a means or a goal to accumulate the funds necessary to do this down the road. If we are going to own as a nonprofit a commercial entity, obviously there's greater operating complexity. We're now operating two different types of activities, one that's focused on our mission, the other may be focused simply on the sale of goods and services. We need to look at our governance structure. If we want to maintain that autonomy and treat this as a separate business, we're going to need board members and leadership of that commercial enterprise, and that may require a different set of skills in our board members. And what you're going to want to do, I think, to ensure success is you're going to want to have an advisory board and a board that's made up primarily, perhaps, business owners that can provide you advice and counsel ongoing on how to run and operate the business. Depending on how we raise money, depending on the industry we're in, we can open ourselves up to additional regulations, not only governing our operations, but there are regulations and securities laws that we need to consider in how we raise money. And then we have the issue of dissolution considerations. If the operation doesn't work, typically the business, if it goes out of business, it goes through a formal bankruptcy proceeding. Then vendors, those outside investors, employees, other third parties are going to have preferences on the distribution of what equity or what cash is left as we wind down those operations. Different types of subsidiaries. The most common one frankly, that we've seen historically has been the development of an independent corporation known as a C corporation. Now, what is a C corporation? Well, it's a separate legal tax-paying entity. So whatever income tax considerations there are associated with the income of that entity are taxed at the corporation level. So that obligation to pay tax doesn't fall back on the nonprofit organization. As I mentioned before, it provides risk protection because we isolate the risk associated with those ongoing business activities inside that organization. Where if we are carrying out that unrelated business activity inside our nonprofit, legal, litigation issues, regulatory issues, those liabilities and those risks are going to come to bear on the nonprofit. We can have outside shareholders, like I mentioned. If we cannot finance the whole deal, we can go out and encourage the others to co-invest with us in the creation of the organization or the corporation rather, and not only do we get their capital, but we also, to a degree, we diversify our investment risk. Dividends, and this is important in a C corporation structure. Unlike other pass-through entities, and I'll describe those in a second, dividends typically for a nonprofit organization, and if you all have an investment portfolio, you're receiving interest and dividends, on your Merrill Lynch or your Schwab account now. In the Internal Revenue Code, dividends specifically are considered passive income, and they don't typically give rise to unrelated business income tax issues. So if the corporation is profitable, they can pay an annual dividend, and that source of cash could come into the nonprofit organization tax-free. Now, there are some provisions, I put that in the last bullet point here, where those passive sources of income could be subject to unrelated business income. And the most common one that is encountered is we made an investment in a commercial corporation and we borrowed the money to make that investment. So it didn't come out of our financial reserves and we actually financed it. The Internal Revenue Service takes the position that the dividends coming back to the nonprofit organization primarily are to help pay the debt obligation and not for general use in furthering the organization's mission and program activities. Another corporate entity structure that you could consider would be a limited liability company. These became very, very popular around 15 years or so ago. Think of your typical sole proprietor to receive some general liability protection. You can form a single member LLC. Now, the advantages of a single member LLC, and there are some disadvantages as well, is that they're very, very easy to set up. You can file, you can go online, file with the state. You can go out online and download, a boilerplate LLC organization agreement. It's a disregarded entity. So the profits and losses of that activity get reported in the organization's 990. We don't have to file a separate tax return, which we would have to do for a corporation. Again, the issue here that we need to be aware of is if that activity is unrelated to our core mission, then all of the income tax liabilities and the requirement to pay tax on that unrelated business income now becomes the responsibility again of the nonprofit organization. The other issue we need to look at in this kind of environment is depending upon the profitability of that single member LLC and the amount of revenue that it is generating on an annual basis, that will need to be taken into consideration as the organization determines its public support test. I'm not going to get into all the regulations around that, but if you're a 501c3 public charity, The Internal Revenue Code is defined that only a certain percentage of your organization revenue can come from unrelated sources. If you put that organization in a separate corporation, it's a separate legal tax-paying entity, and it will not impact that public support test. Another downfall with, or consideration rather, in single-member LLCs, much like my earlier comment about sole proprietorships, is sometimes in litigation settings, if there's ongoing, lawsuits or damages being sought by a third party, the courts sometimes struggle in defining whether or not, the LLC is separate from the nonprofit. It doesn't file a tax return, so maybe really it's just all the same organization. So there could be some concern around liability protection and things of that nature. Okay, some initial investment considerations, because this is where the rubber meets the road. Whether or not we're in a position because we have adequate reserves to consider doing this now. The initial investment is also going to determine whether or not we can own all of the corporation, for example, or whether or not we need to seek outside investors. So this particular slide, we just try to walk through the main things that you're going to have to consider as you have this discussion and you incorporate this into the financial plan, component of your strategic planning. We need to have a good understanding of what is the initial investment for working capital. One thing that often gets missed is we know we're going to have $200,000, let's say, to build a building, hire people. And then what we forget to consider is, do we have adequate working capital to help finance operations and keep things running through that initial startup phase? Facilities and supply costs, another thing to consider. Is this something that we're going to have to go out and build a new building or either acquire a building or lease a building? So we need to make sure we understand, what are the costs associated with facilities to operate the corporation or to house the activity, supply costs, vendor relationships, those types of things. We need to also be very, very aware that there's a need for professional management. For this to work and work well, and I've seen this in my career, where we decide to engage in one of these activities and we take a very, very effective manager, middle manager, senior management person on the programming side of the nonprofit, and we now tell them, you're going to be in charge of the business over here that we're going to operate to build widgets. And they really have no experience in how to run a commercial enterprise. So don't overlook the fact that we are going to have the necessary, skills and knowledge and experience in our leadership team. And that more likely than not is going to require the organization to look beyond, its existing human capital to attract that professional management. There's going to be hidden costs always associated with incorporating, legal fees for incorporation, registrations with the state. There could be deposits, and things of that nature that are required for payroll or sales tax reporting purposes. You may actually find that you need, legal and financial and accounting advice from a different set of providers. You may be working with an organization that has a great deal of experience in working with nonprofits, but they really don't do any consulting with commercial businesses. Again, you may have to look at a different set of providers to help you with your tax filings, and other types of things. We also need to make sure we don't overlook state requirements. Every state, basically, I believe in the union now, has a MIFA, legislation at the state level, and that really governs whether or not a nonprofit's activities, and investing decisions are prudent. So we need to be aware of that legislation. And then obviously, I mentioned before, unrelated business income tax issues, particularly if we are financing this type of endeavor on borrowed money. The most important consideration, frankly, and this is no different than the decision that you make when you open that Merrill Lynch account or that Schwab account, and that is 100% of the investment in this nonprofit subsidiary is going to be at risk. Now, the thing that makes this strategy different than that brokerage account is if the bottom falls out, it's not easy to sell and liquidate a corporation to convert it to cash. And what this is going to require your leadership team to say is, can we afford the investment? Are we willing to take the risk? And perhaps we can do that. Now, what type of company? Well, we can always go into this, put on our entrepreneurial cap, and we can form a startup company. Maybe we have an idea of a product or service that we believe the market needs and no one else has thought about. I will tell you, if we're going to invest in a startup startup company rather, this is going to be costly. Because not only do we have the investment in bricks and mortars and people and supplies and all of these things, but we're also going to have a lot of cost in the initial startup period, if you will, building out infrastructure, revisions to product design, revisions to service offerings, marketing cost, because we are going to have to go out and educate the market on why they should buy the product or service. We don't have a proven track record. This would be a very costly approach. Now, we all saw the big tech bubble, the big upside benefit, to the startup. If it's truly a revolutionary idea, and we often can find ourselves in the position like an Apple, for example, where we come up with the latest, greatest, way to skin a cat, so to speak. And suddenly it becomes worth a lot of money and it gains a lot of interest. And we can find buyers then that are going to give us, very high multiples of our investment to buy the operation from us so that they can carry it on. Typically, this, as I said, this is going to be expensive. More often than not, you're going to have to attract others to make this work well. And the others are either going to have to bring in financial resources to bear to help fund the startup, or they're going to have to bring technical expertise to the table to help get the endeavor off the ground. You can buy an existing business. Acquiring an existing business has its advantages over a startup company in that it's an ongoing operation. So they already have customers, they already have vendor relationships, they've got systems, processes, and the likes. So we are stepping into an owner's shoes, and that's a lot less heavy lifting than starting something from scratch. But typically, they'll have a professional management team already in place. Often when we structure the transaction as part of the compensation to the individual selling the business, we can, negotiate terms where they continue to be involved after the transaction to provide for an orderly transition. We can build in provisions where possibly part of the purchase price is financed through an earn-out type of agreement, where I'm going to give you so much cash at closing, and then I'm going to give you a share of the income or revenue for the next 5 years. That's a good way to hedge the risk. And buying an existing business, unlike starting a startup, there are numerous organizations out there, that can provide assistance and consultation, to not only help business owners sell a business, but they have access to channels that, depending on your risk profile, the type of business you're looking for, they could help you identify businesses for sale. I want to kind of wrap things up here by introducing a concept here that's kind of a little bit like an existing business, but perhaps has a little easier entry point financially, and an opportunity, to perhaps have a little bit greater success, and that is a franchise. What are the advantages of investing in a franchise operation? Well, the products and services the franchise offers, they've already been trusted in the market. You get the opportunity to leverage and exploit that national brand rather than going out like with a startup and trying to create the demand. The franchisor, as part of the franchisee licensing agreement, more often than not, I think almost all the time, is going to share with you formalized operating structures, policies, procedures. They offer ongoing training for execs and new employees. They have established hiring practices. All of those things you can receive as part of that franchise agreement. Typically, they also have ongoing support for management and the franchisee into the future. Believe me, when McDonald's decided to bring back the McRib sandwich, they took care of all the marketing. They put you in touch with all the vendors and suppliers that would be necessary, for you to begin offering that particular sandwich. All the instructions on how to put it together. They provided you all of the collateral material to update your drive-up menu boards. All of that comes as part of the deal. Now, in exchange for that, you not only pay the initial franchise fee to buy that license, and an important characteristic of that license, they also guarantee you a defined business territory where another McDonald's operator cannot enter that territory and compete with you. But as part of the agreement, there are going to be ongoing franchise fees, typically those royalties, if you will, for all the support. It's typically a function of the revenue dollars generated. They can also help provide resources and access to financing if you want to buy a McDonald's franchise and you have to build a restaurant. They already got a vetted list of developers, in your region that come in and build the store to spec. They already have all the plans. They already know how everything fits together. And often they can help with financing, the construction, or at least give you access to who will provide financing. They've got established vendor relationships for their procurement of supplies, and they're buying in bulk, so they're buying cheap. And you get the benefit of that. Often that initial franchise fee is a less expensive investment than buying an existing business. Most business owners selling a business, they want as much money as possible at closing. What does a franchisor want? They want an initial investment. Obviously, sometimes that's going to be less, but they're also going to receive those royalties in the future. So part of the money we're paying for the endeavor is to leverage all the resources they can provide. And in exchange, we have to agree to give them a share in that profitability or the upside after that initial transaction. They offer resources to help develop your business plan. And believe it or not, I found in my research, a number of national franchisors do have programs focused on attracting tax-exempt organizations to own a franchise. So to kind of summarize, what do we do? How do we decide what to do? Well, if you look across the continuum here, first we need to evaluate the need for revenue diversification as a component of your strategic plan. Second step is going to be critical, is determining, do we have adequate financial resources to invest in an unrelated business activity? If we don't, do we have a means and a desire to accumulate those resources to make an acquisition in the future? Then, once we've made that decision that we're interested, now we need to begin to have the discussion about identifying what would be appropriate potential investment opportunities. Once we've identified one of those, we need to say, okay, if we're going to acquire this McDonald's franchise, for example, what are we going to need in terms of professional management to make this a success? Not only the type of individual, the necessary education and skill set, but what's going to be the financial investment to make sure that we have someone in place that's capable of managing and running this business on a day-to-day basis, successfully. Then we're going to have to look, and don't overlook at this, is going to be what is going to be the community's perception of our engaging in this activity. We need to be cognizant of the fact that if you own a business, there could be donors then that are going to say, well, if they have this investment and they're operating a McDonald's franchise, then they don't need my donations anymore. So we really need to consider, what's the perception. You're going to have to engage, as I said before, engage and work with a set of professional advisors. Those advisors, can help you then assess regulatory and tax reporting issues. And then, probably the final thing, once we've looked at these, is do we have the expectation of the financial return from making this investment really is going to be worth the risk, worth the hard work, and how does it align with our financial needs for us to carry out our core mission activities? Now with that, that's the end of our recorded session. I will join you in a few minutes with Corey Taylor, and he and I will moderate and conduct our Q&A session, which is live. I'm looking forward to meeting all of you and answering your questions, and I thank you for your attention during the presentation.
Well, thanks, Bob. We appreciate you taking some time out this morning to give us some good insights on social enterprise and how that can impact our nonprofit organization. Good morning, everyone. My name is Corey Taylor, and I'm with Brady Ware. And we're going to continue Bob's session by looking at some questions that came in during the presentation. I would encourage you as we go through this Q&A, if other questions come to mind or pop up, feel free to use the Q&A feature, and we can continue to look at those questions. So let's start with one, Bob. You mentioned often the need for professional management. What is the role of the executive director with respect to commercial business entities?
Thank you, Corey. As I indicated, one of the strategies or benefits, if you will, of organizing this unrelated business activity in a separate legal entity is that enables us to go out and hire professional management for that business enterprise. The example that I've seen happen in the past during my career is often we will consider engaging in this type of unrelated activity, and we'll take a very solid, well-performing middle manager, and assign them the responsibility now of leaving the program side of the organization to oversee, this business activity. With this separate structure, if you will, the role of the executive director, as far as oversight of the commercial business entity, the executive director's role really remains to some degree unchanged. They still have the responsibility for the 501c3's core operations. Obviously they make hiring decisions. They're involved in setting strategy. And this other entity, this other activity, if you will, really needs to be focused and viewed as though it's an investment. So the executive director's role really would be to monitor the performance of that organization against expectations, the commercial entity's business plan, any financial projections, budgets, if you will, and that type of performance. But the day-to-day management of the commercial business, if you will, really resides with the chief executive that would be hired to run that commercial activity. So I hope that answers the question.
Okay. It seems like investing in a separate business would be very expensive. Can you explain why an organization would do this if you could simply run the business activities inside the existing nonprofit?
Okay, as covered in the presentation, depending on what the organization ultimately would choose, if they do choose to invest in a separate legal entity type of structure, as indicated, depending upon what type of transaction they choose to execute, whether it's a franchise or whether it's the purchase of a existing business, that's going to require startup capital. The reason, if you will, for a nonprofit to consider developing a strategy to make this type of investment and separate it from the nonprofit organization really are the benefits that were covered in the presentation. The ability to hire professional management that's focused on the commercial business activity. It provides that regulatory, if you will, that risk protection, because if anything were to happen, adversely, inside the commercial activity, it's independent of the nonprofit. It becomes difficult in a litigation setting to, pierce the corporate veils. So we can isolate, the risk, where if we put it inside the nonprofit organization, we have a whole lot of other considerations. We expose the organization's resources to that risk. If the commercial activity were to be sued by a customer or someone receiving services from that enterprise. The other issue really relates to unrelated business activities. If we are going to do a commercial activity inside the organization, I think it becomes then much more important that ongoing trade or business activity that's conducted on a regular and ongoing basis, if it's not directly related to the fulfillment of our mission, it opens us up to unrelated business income tax exposure. The gross revenue associated with those activities now becomes a factor in determining our public support test. So depending upon the profitability of the revenue generated, we could expose the organization, to difficulties in meeting that public support test, which puts your 501c3 at risk. So those are really the two primary benefits. In addition to, if we choose to invest in a regular C corporation and we did not finance the investment in that activity, then that allows us to receive the dividends, at the end of the year. In effect, since that's exempt under the IRS code, and classified as investment income, we can harvest the cash in profitable years and not run the risk of having to, pay tax, on that revenue stream.
Well, certainly there are some costs and it could be expensive, but I think the benefits far outweigh them, in doing this separate entity. You did mention, Bob, that this could be subject to UBIT, unrelated business income taxes. I did want to remind the group here, Mary Colgate did a session on that as well. While Bob's presentation was also going on, you will be able to view that at a later date. So that will be made available, again, if that's something you would like to learn and know more about, especially as it could relate to social enterprise. Moving on then, Bob, you mentioned one alternative is to purchase an existing business. What type of businesses should we buy?
Well, that's a pretty broad question. I covered in the presentation, and frankly, in doing the research for the presentation, I was a little bit astonished in looking at the number of national franchisors that have developed programs to assist exempt organizations in purchasing a franchise. This question sounds like we're talking about just buying an existing standalone business. What type of business is really going to depend upon a number of factors, for the exempt organization. What are the general nature of the trade or business activities? Is it something that the organization and organization leadership feel that that they're able to manage? Does it fit their investment profile? Virtually, as far as what type of business to purchase, it's pretty much wide open. I know we have encountered, at Brady Ware, some situations with clients where we may choose, for example, that there's a local community business that's got a sound reputation. It's been around for a long time. They manufacture products for resale. They've got a proven financial track record. So really, the opportunities are endless. What I would encourage, as far as determining what type of business to buy, really, I would encourage the leadership of an organization to engage more often than not, a business broker, to help explain, not only how to structure a transaction, but to also help do due diligence on, the expected future performance, if you will, of the business enterprise. Wish I had a better answer. There's no magic pill, if you will, for me to say, you should go out and buy an auto shop. One thing, though, that you may want to consider looking at which type of business or which commercial business to purchase is always look back to your core mission. And is there a way that we can engage in an activity, even though it may be in a separate legal entity, that is somewhat related to our desired mission outcome? And the examples that come to mind for me would be, if we are working with individuals that have disabilities, or other types of challenges, is that commercial activity something that could provide employment opportunities for the people we serve? You can go out and look at it. There are a number of organizations focused on targeted populations. So is there a connection there that we could consider? I know from prior conferences, we've done some sessions on just true social enterprises where we're looking for that absolute type of related activity. So if we're working with folks that are transitioning from addiction, can we provide employment opportunities? Same thing with folks that are trying to transition back in, after incarceration. Are these activities where we can make that type of linkage? I think is something also that you would want to consider.
Okay. If we are just going to take a portion of our business that is subject to UBIT and separating it out, say into another entity, what consideration should we have in that situation?
Great question. Again, I think it comes back to, if we look first at what's our core mission, What are we trying to accomplish from a mission perspective? I would look obviously to the past if this is an ongoing activity that we've been conducting inside our organization. Is that activity profitable? As I mentioned before, are we having difficulties? Working with our accountants are warning us that we're too close to failing our public support test. Another thing, and we've seen this, Corey, you and I, and a client that we have in common, they ran a sheltered workshop program, and they reached a point where they began experiencing, which was a good thing, a really robust demand for the services that were being carried out in that workshop. And initially, when they set it up inside the nonprofit, it was to employ or to provide work opportunities for the individuals that they serve. Mm-hmm. And suddenly they found themselves in the good position of having increasing demand for the service that they were providing, to the point where they could no longer meet that demand, if you will, from the constituency that they were serving inside the organization. So they came at sort of that crossroads where they were struggling with, now how do we go out and hire individuals from the community at large to come to work for us, to work in that sheltered workshop environment, which really was founded more as a program activity than a revenue diversification strategy. That might be an instance where the business signals are there that we need, there's untapped demand, there's an opportunity to grow this activity. Do we want to put it in a separate entity? Do we want to go out and, instead of having, as I mentioned before, program individuals, managing it, that we want to put it in a separate organization? Maybe we want to invest in a new facility, invest in a new management team, and we have that opportunity really to drive that top line revenue and create a greater financial return for the organization.
All right. Well, all good questions. Bob, again, we thank you for your time in doing this Q&A. Unfortunately, that's all the time we have for questions. We would encourage you to visit the exhibit hall and also stick around for our final speaker. Thank you for your attendance and taking some time to spend with us today.
Everyone have a great day and enjoy the rest of the conference.